Welcome to our deep dive on whether maxing out a Roth IRA early is a genius move or a disaster. In this video, we will unpack the financial foundations you need, the timing advantages, the lump sum versus dollar cost averaging debate, and where to invest inside a Roth IRA. We will also cover actionable steps, compare brokerages, and end with key takeaways. Let's get started. Here is our roadmap for today. First, why starting in your 20s is so powerful. Then, we will confirm your emergency fund. Next, we will highlight the Roth IRA advantages, timing and deadlines, and the lump sum versus dollar cost averaging debate. Afterward, we will cover where to invest, a practical action plan, and risk and behavior insights. Finally, we will summarize and test your knowledge with quick quizzes. Beginning in your 20s amplifies the effect of compounding. Even small contributions can grow significantly over long periods. As we move forward, remember that time in the market is a key lever in building wealth. Before investing in any retirement account, verify your emergency fund. For variable income earners such as contractors, target 6 to 12 months of expenses. For more stable income, 3 to 6 months may suffice. Keep this cash in a high-yield savings account for safety and quick access. Once your cushion is set, any remaining cash flow can be allocated to tax-advantaged investing, starting with your Roth IRA. This decision tree illustrates the order of operations. First, check if you have an emergency fund. If not, prioritize building 6 to 12 months of expenses in a high-yield savings account and automate contributions until you reach your target. Once complete, begin funding the Roth IRA. If you already have the emergency fund, move directly to funding the Roth. The key theme is consistency after establishing a safety net. A Roth IRA allows your investments to grow tax-free and to be withdrawn tax-free in retirement, provided you follow the rules. This is particularly beneficial if you expect to be in a higher tax bracket later. Additionally, Roth IRAs do not require minimum distributions during the owner's lifetime. As a flexibility bonus, your contributions, though not earnings, can usually be withdrawn tax and penalty-free, offering emergency flexibility without undermining the account's purpose. You may contribute toward the prior tax year until the tax filing deadline, typically in mid-April of the following year. Rather than waiting, contribute as early as possible to maximize time invested. For example, if the annual limit is $7,000, fund that amount as soon as you can, and then begin contributing toward the next year's limit. Be sure to confirm current IRS contribution limits and income eligibility rules, as they can change. Question: until when can you contribute to a Roth IRA for the prior tax year? Options: A. December 31st of that year. B. Typically by the mid-April tax filing deadlines. C. June 30th of the following year. D. Only during open enrollment season. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. You can generally contribute for the prior year up to the tax filing deadline, typically in mid-April. Lump sum investing tends to outperform dollar cost averaging in roughly 2/3 of historical scenarios because markets generally rise over time. However, DCA can provide emotional comfort by smoothing volatility, which may help you stay invested. Over a 30-year horizon, the difference between the two methods often becomes small. The worst outcome is failing to invest. Choose the method that lets you stay consistent. This timeline contrasts two strategies for the same total annual contribution. The lump sum path invests everything in January, maximizing time in the market for that year. The DCA path spreads contributions monthly, resulting in gradual market exposure. The trade-off is clear. Lump sum increases time in the market, while DCA offers a smoother emotional experience. Over long horizons, both can work if you remain consistent. Question: over 30 years, which choice is usually the worst for building wealth? Options: A. Lump sum investing. B. Dollar cost averaging. C. Not contributing at all. D. Switching funds once a year. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Not contributing at all is typically the worst decision because it forfeits compounding and tax-advantaged growth. Inside a Roth IRA, low-cost index funds are a straightforward way to capture broad market returns. Consider total market, or S&P, 500 index options from established providers. Focus on keeping expense ratios extremely low. As your timeline shortens or your risk tolerance changes, you may add a bond fund to moderate volatility. Always verify each fund's objective, fees, and tracking method. This pie chart shows two simple allocation concepts. Option A places 100% in a U.S. total market fund, which maximizes equity exposure and potential long-term growth, but increases volatility. Option B allocates 80% to a U.S. total market fund and 20% to a U.S. bond index, which may reduce volatility while slightly lowering expected return. The right mix depends on risk tolerance and time horizon. Follow these steps to execute. First, confirm and automate your emergency fund. Next, verify your eligibility and current contribution limits for a Roth IRA. Then, choose a reputable brokerage such as Vanguard, Schwab, or Fidelity and open the account online. Fund it early, either as a lump sum or via monthly DCA. Select a broad market, low-cost index fund. And finally, set reminders to review your allocations and rebalance once a year. This comparison highlights that Vanguard is known for its index fund leadership and investor-owned structure, often favoring a straightforward, no-frills experience. Meanwhile, Schwab and Fidelity offer robust platforms, comprehensive tools, and strong service. All three provide low-cost index funds. Ultimately, pick the provider whose interface, service, and fund availability you prefer. Here are example ranges of expense ratios for popular low-cost index funds. Exact fees vary by share class and provider. Always verify the current expense ratio on the fund's official page before purchasing. Expect volatility, because it is the cost of long-term equity returns. If market swings make you nervous, use dollar-cost averaging to maintain discipline. Automate contributions to remove the need for frequent decisions. Above all, avoid high fees and reactive fund switching, which often harm long-term outcomes. Here is a simple Markdown checklist you can copy into your notes. It includes the emergency fund, eligibility check, brokerage selection, funding method, fund choice, and annual maintenance. There is also a suggested yearly flow. First, max the prior year by the deadline, then start the current year immediately, and finally rebalance once per year. This mind map organizes the key components of early wealth building with a Roth IRA. The Foundations branch covers the emergency fund, budgeting, and insurance. The Contributions branch reminds you to fund early, choosing either lump sum or DCA. The Investments branch focuses on total market exposure, low costs, and diversification. The Behavior branch emphasizes automation, ignoring short-term noise, and periodic rebalancing. The Compliance branch includes IRS limits, income phase-outs, and deadlines. This content is educational and not financial, tax, or legal advice. Circumstances vary and regulations change. Verify current IRS limits, eligibility, and tax rules. Consult a qualified professional before taking action. The main points are as follows. Start early to capture compounding benefits. Secure your emergency fund first. Maximize your Roth IRA contributions as early as possible. Use low-cost, broad market index funds. Finally, focus on consistency through automation rather than market timing. In summary, provided your emergency fund is established and you are eligible, maxing out a Roth IRA early is generally a strong and often mathematically superior strategy. Lump sum has an edge historically, yet your best method is the one you can consistently follow. Keep fees low, diversify broadly, automate contributions, and verify IRS rules every year. Stay disciplined for long-term success. If you found this helpful, please like the video, share it with a friend, and subscribe for more. Tell us in the comments whether you prefer lump sum or dollar cost averaging and why. Your experiences can help others learn.